You have probably said the words, "I want to invest in stocks," at least once in your life. Maybe you have even done it, opened an app, tapped a few buttons, watched a number go up or down. But if here's a question that most people who invest cannot actually answer: what did you just buy? Not the company name, not the ticker symbol. What did you actually receive in exchange for your money? Because when you buy a stock, a single share of any company, you're not buying a product, you're not buying a service, you're buying a piece of ownership in a real business. And that one idea, ownership, is the thing that separates people who build wealth from people who just watch numbers move on a screen. By the end of this video, you will understand exactly what a stock is, what equity means, and, most importantly, what you are actually entitled to as an owner. Not in theory, in practice, what it means for your money. And I'll tell you something near the end that most people who have been investing for years still get completely wrong about what owning a share actually gives you. Stay for that. It might change how you think about every investment you ever make. Let me take you back to a small town in 1985. Marcus runs a bakery. It is a good bakery, lines out the door every Saturday morning, loyal customers, real profit. But Marcus has a problem. He wants to open a second location across town, and he needs $50,000 to do it. He goes to his friend Daniel. Daniel has saved up exactly that amount. He believes in Marcus, believes in the bread, believes in the Saturday morning lines. So he hands over the $50,000, and Marcus, sitting at his kitchen table that evening, writes on a piece of paper, "Daniel owns 20% of this bakery." That is it. That is the entire foundation of what we are talking about today. That piece of paper is a share. Daniel's 20% stake in the bakery is his equity. And the deal they just made, money in exchange for ownership, is the oldest financial transaction in human history. Long before Wall Street, long before the NASDAQ, long before anyone had a brokerage app on their phone. Everything you will ever learn about stocks, shares, and equity is just a more complicated version of Marcus and Daniel's kitchen table agreement. Keep that image in your head. We are going to come back to it. So what does Daniel actually own now? This is the question most people never think to ask. He does not own the oven. He does not own the flour. He cannot walk in on a Tuesday and take the cash register home. What he owns is a claim, a legal, formal, enforceable claim on three things. First, a share of the profits. Every time the bakery has a good month and Marcus decides to distribute earnings, Daniel gets 20% of whatever's paid out. That payment is called a dividend. Think of it like rent from a property you own. The building keeps appreciating, and meanwhile, it pays you every month just for owning it. Second, a share of the assets if everything goes wrong. If the bakery closes, the ovens and equipment get sold, the debts get paid, and whatever remains, Daniel gets 20% of it. This is called a liquidation claim, and it matters more than most people realize. Third, a voice. Daniel gets to vote on major decisions. A new partner joining? Vote. Selling the business? Vote. His 20% means his opinion carries real weight. Ownership is not just a number, it is a bundle of rights. And when you buy a stock, any stock, you are buying that same bundle. Smaller, yes, but the same in every important way. Now, the bakery grows. Marcus opens 3 more locations. Revenue is strong. Word spreads, and suddenly, people who have never met Marcus want in. They have heard about the lines, the profit, the expansion, but Marcus cannot sit at a kitchen table with 500 strangers. So here's what happens. Instead of one piece of paper that says Daniel owns 20%, they divide the entire bakery into 10,000 equal pieces. Each piece, each share, represents 0.01% of the business. They price each share at $10. Anyone who wants to own a piece of Marcus's bakery can buy 1, 2, 100, as many as they want. And now, if Daniel wants his money back, he does not go to Marcus. He finds someone else who wants to buy his shares. He sells his ownership to them. That transaction, stranger buying ownership from stranger, is exactly what happens millions of times every day on the New York Stock Exchange, the London Stock Exchange, every major market in the world. A stock exchange is not a casino. It is not a guessing game. It is a regulated marketplace where ownership stakes in real businesses are bought and sold between willing people. The price moves because people's opinions about the business's future change, but the underlying thing being traded is always the same: ownership. Here's a question I want you to sit with and drop your answer in the comments. If someone gave you $1,000 today and said you had to buy shares in one company and hold for 10 years without checking the price, which company would you choose and why? I read every reply.
Now, here is the uncomfortable truth I promised you, and I mean it. Most financial content will not say this directly. When you own a share of a company, you are last in line, not second, last. Think about everything a company owes before it owes you anything. It pays its employees first. It pays its suppliers first. It repays its bank loans first. It settles its taxes first. If the company gets into serious trouble and has to shut down, all of those people have a legal right to be paid before you see a single dollar. Shareholders get what is called a residual claim. You own whatever is left after every other obligation is settled. In a bad scenario, that could be nothing. I am not telling you this to scare you away from investing. I am telling you this because this is the deal. And understanding the deal fully, honestly, is the only way to make good decisions with your money. Here is the other side of that deal. When the business thrives, when it keeps growing, keeps earning, keeps compounding, that residual claim becomes the most valuable thing in the room. The employees got their salary, the bank got its interest, and you, sitting quietly at the back of the line, own the entire surplus. Every dollar of profit the business generates beyond its obligations belongs proportionally to you. That is why equity has historically outperformed every other asset class over long periods of time. The risk is real, so is the reward.
Let us go back to Daniel. It is now 2005, 20 years after he handed Marcus that $50,000 at a kitchen table. Marcus's bakery became a regional chain, 40 locations across 5 states. The business was eventually valued at $8 million. Daniel's 20% stake, that kitchen table agreement on a piece of paper, is now worth $1.6 million. Daniel did not bake a single loaf. He did not manage a single employee. He did not open a single new location. He just owned something, and that something grew. This is what capital appreciation looks like in real life. The value of your ownership stake rises because the underlying business becomes more valuable. And here is the part that makes equity genuinely different from almost every other investment. The business can reinvest its own profits to grow even faster. Marcus did not just pay out every dollar the bakery earned. He used profits to open new locations, which earned more profits, which funded more locations. That cycle is called retained earnings, and it is the engine behind compounding ownership value. When you buy shares of a growing company, Apple, a local bank, any business you believe in, you are Daniel. You are not a trader. You are not gambling on a price chart. You are an owner of a real enterprise, entitled to your proportional share of everything it builds. That shift in how you see yourself, from someone watching a number to someone who owns something, is the edge most investors never develop, because they were simply never taught this.
So here's the thing most people, even people who have been investing for years, get wrong. They watch the price every day, every hour. They feel good when it goes up and anxious when it goes down, and they make decisions based entirely on that movement, buying when excitement is high, selling when fear takes over. But that is not how an owner thinks. An owner asks different questions. Is this business earning more than it did last year? Is it growing its customer base? Is it reinvesting wisely? Is the thing that made it valuable in the first place still true? The price is just the market's current guess at what your ownership is worth, and markets, in the short term, are emotional, impatient, and frequently wrong. The price will fluctuate. The ownership does not. Your 0.01% of that business, your claim on its profits, its assets, its future, does not change because someone else panicked and sold their shares on a bad Tuesday. Here's what I want you to do this week. One specific thing. Open your investing app or brokerage account. Find one company you own or are seriously considering, and instead of looking at the price trend, look at the revenue trend over the last 3 years. Is it growing? That single habit, evaluating the business, not the price, is the difference between speculating and investing, between watching and owning.
Stocks, shares, equity. 3 words, 1 idea. You are an owner. Not a spectator, not a gambler, an owner of real businesses with real claims on real profits, entitled to everything those businesses build proportional to what you hold. Marcus built the bakery. Daniel owned a piece of it. And 20 years later, the person who showed up with $50,000 and a belief in Saturday morning bread lines walked away with 1.6 million reasons to understand what ownership actually means. That is available to you right now through any brokerage account in any country with whatever you can responsibly set aside. The mechanism is the same. The principles are identical. The only thing standing between you and that understanding was this video. Before you go, one question for the comments, and I genuinely want your answer. Before watching this, did you think of yourself as an owner when you bought a stock, or just someone watching a number? Tell me how that answer has changed. I will be reading every single one. If this reframed how you see investing, share it with one person in your life who keeps saying they want to start but hasn't. That one conversation might matter more than you think. And subscribe, because every video on this channel is built exactly this way. No jargon, no shortcuts, just the real explanation you should have gotten years ago.